KAGI trading charts are another unique invention from Japan that really do create a different type of edge to your trading, similar to Renko, but from a different perspective. Like I said, they can create really powerful, unique trading strategies that give you that different look in on the market. Now, they might look a bit strange to start with. They are very straightforward, let me tell you that. And if you are new to KAGI and want to learn more before maybe diving into this video, then at the end of the video I will put a link to a completely free KAGI course that I run here on YouTube, so please do jump into that to learn more. But in this video we're going to look at that unique nature of the KAGI charts, because I find that KAGI charts are better for more price action trading. They're a bit harder to add indicators to, like if you follow the channel, you've seen on my Renko videos. So they, to me, require a slightly different tack to what we're used to, and that involves more price action trading. And they have their own unique set of patterns, terminology, things to look for, and we're going to cover them off. We're going to build up the idea of these patterns and then look to try and then create our own strategies off the back of them. So with that, let's get into the detail. I thought I'd address this point before I get asked it in the comments. Now, in this video I'm using TradingView, and that creates its own unique set of nuances to setting up KAGI charts. It's the same for Renko and in some respects line break charts as well, and it all comes down to time. Now, the pure rules of KAGI say it's only about price action, but a lot of the modern technical analysis packages, they introduce a time element. It's a default site setup and it just is there. Now, like I said, if you're lucky enough to have a package that doesn't have that, then you don't have to worry, but most of you using TradingView will have to take that into consideration. So I wanted to run through a quick example just to show you the impact. At the moment we're looking at the US dollar against the Japanese yen. It's set to daily, as you can see there in the top left. Now I'm going to just actually leave this as a fixed one size reverse amount. That's the yin and yang lines. You can set it to HR, which calculates it yourself, but just notice now the shape of the lines and the patterns that it creates. And then if we flip it down to say 1 minute, actually in this instance 1 minute for KAGI is far too big, and we need to actually readdress what we're going to use there. So let's, for this example, just flick it to ATR 14 period. But my point here is that it creates a completely different picture to the KAGI yin and yang lines, which is good and bad. Good because it creates a lot of possible new opportunities. By introducing this time element, you can create intraday strategies around these time frames. Now, the bad is because it brings in confusion, and it's sort of against the traditional KAGI Renko line break theory. So it's something to really consider and think about when you're using your charts. Like I said, if you've not got this problem, it's just set to price action only, then nothing to worry about. But if you're using a package like TradingView, then do take into account how time frames can distort and change the face of the KAGI chart, and therefore like we say, can create different types of strategies, and like I said, also opportunities. So there you go, just wanted to address that and put that one to bed. So there are a lot of KAGI price patterns that we need to know about, and you can introduce some of those Western ones as well, the traditional ones, you know, the triangles, the pennants, the continuation, the reversals, and some of them do overlap, but we need to focus in on the key ones, the specific ones to KAGI that we can create, you know, price trading strategies around, and we're going to look into those now. Now what you'll notice about KAGI chart patterns is actually they're very similar to their Western counterparts in, say, bar charts or the candlestick charts. You'll be familiar with the sort of shape of a lot of these. They have slightly different names that you'll need to learn in the KAGI chart world, but also there's some very subtle and clever analysis which is unique to KAGI that's worth learning, which can seriously help your trading and create very specific trading strategies. In this section we're going to look at shoulders and waists, price breaks, line lengths, reversal line points, double windows, tops, bottoms, trend lines, Buddhas, and shoulder or waist chains. So a lot to cover off, but like I say, very useful for you to know and learn. So our first KAGI chart pattern revolves around what's known as shoulders and waists, which is unique to the KAGI chart. A shoulder is a prior high and a waist is a prior low, and what it can be used for essentially is to gauge the sentiment of the current trend. So you look for a series of shoulders or a series of waists to give us an idea of the strength of that trend direction, and we can also look for a reversal in that strength where the current shoulder or waist is either lower or higher than the prior shoulder or waist, which can signify a change in supply and demand. Let's now look at an example of that. So here's our example on the S&P 500 stock index. I've marked on shoulders and waists, and we can see the shoulders are basically turning points at the end of a bullish up run, and the waists are turning points of a bearish down run. Now they may continue, they may not, but they are important points on the KAGI chart to be looked at and analysed, because they will obviously tell you about the sentiment of trading currently and the strength of that sentiment as well. Next up is price breaks. Now this enhances the probability of success when those trend lines change colour. Now in this instance you're going to wait until two or more prior high or lows have been penetrated. It's up to you. If you want to stick to the two, you could be even more patient, go 3, 4, 5, whatever. It's up to you, but higher you go, probably the risk return starts to run against you. So let's take a quick look at an example. Now this is an example on the S&P again, but this time it's on an hourly chart, so we've sped things up a bit, and it's a buy example. You can see in the bottom left we've turned from red to black around 3 o'clock. Now old rules say you go in there, and yes, that would have worked in this example, but the odds are against you, so we wait until that second high is broken around that 3921 level, and we enter in. Much safer, and it carried on and was a successful trade, possibly netting you 60 points in the next hour and a half, 2 hours. So a more safe way of trading the change in the line colour. Now your KAGI line has an important centre point, and this can be a reversal line point. For example, if the price reverses after a rally but stops in the upper half of the previous line, that's a bullish indication that that rally is then going to continue as it breaks through that previous high, and vice versa for a bearish trade. If the price reverses after a sell-off but stops in that lower half and then continues to break back down below that previous low, then that's a good sign for a bearish continuation. So let's take a look at an example of that. Again, sticking with our S&P 500 1 hour chart, we can see in the left hand side there, the price has changed from black to red, indicating a bearish sell-off. Now shortly after that 3 o'clock time frame, it then pulls back, but it doesn't pull back over halfway into the bullish zone, so we presume that things are still bearish, and then we will wait for the breakout past that low to then go back into a short trade. So in this instance we would have made a few points, maybe 20 points, hit and run type of trade. Again, just an example of another subtlety of the KAGI chart, and it's vice versa for a bullish setup. Now that bullish bearish zone I drew on, and it's not available, I couldn't find on TradingView, but that might be a function on your charting package to see if you can add on that sort of middle 50% sort of bullish bearish zone line. Now if you're familiar with technical analysis, the KAGI chart pattern double window, tops, bottoms, or sometimes known as tweezers when they're at their high, for obvious reasons when you'll see them in a moment. Very traditional type of pattern, very good for reversals, and the rules, following waist is always above for a double window top, or below for a double window bottom the previous shoulder, and you can have multiple bottoms and tops. You don't just need two, you have 3, 4. Let's take a look at a quick example. So on the left side we have a double window top, so the price has basically been coming upwards. We've been in a uptrend. We get that double top look, and we have a waist line in the middle, and we have 2 shoulders to it, shoulder 1 and shoulder 2. The important thing to note here is we're looking for a gap between the shoulders and the waist, and once that breaks down through the gap, you can trade it. I would probably enhance it further with other indicators and tools, but it's to give you an example of the double window top there. And on the right hand side we have the double window bottom, pretty much it in reverse. The price has been coming down in a bearish trend, settles down, creates this double bottom pattern. Again, we're looking for the gap between the shoulder and the 2 waists, and then we're looking, where the odds are more on our side of the price reversing back upwards. So that is the double window top, double window bottom, and like I said, you can have treble bottoms, tops, more than that, and the theory I suppose is very similar to what you'd see in candlestick and bar charts. Now trend lines are drawn like on any type of chart, whether it be bar chart, candlestick. It's the same in the world of KAGI, and the bearish trend lines are drawn above and the bullish trend lines drawn below. It's a very subjective process which we have to bear in mind, but again it's very useful for looking at or finding reversals in breakouts from trends. So it's worth often applying on top of your KAGI chart. So let's take a look at a brief example. So here we have gold KAGI chart. It's actually a weekly one, so it's really long term. You can see we go back to 2006, so nearly 15 years of data. I'm just going to draw on some trend lines in a subjective type of way. So we find our trend line drawer, and for a bullish trend we could start from here, draw the trend line up, and we have a break. Again for the downside, taking it from the corner there, into there, and we have a break up there. So very easy, very quick to draw on, and helps you determine when these breakpoints in trends have occurred. Now, the greatly named Buddha pattern is very similar to the traditional head and shoulders setup that you're probably used to on a bar or candlestick chart. It's a price reversal pattern, so let's have a look at how it works. On the left we have a Buddha top. What does that mean? Well, that means that the price has been trending upwards and it's created this top like pattern. If we're translating it into heads and shoulders, we've got the two shoulders on the left and right and the head in the middle, and as the price breaks back down and changes colour, I've broken through that low, then we sell it, and we're expecting the price to continue its downward trend. And on the right hand side, the Buddha top, what does that mean? Well, the price has been trending downwards. It creates a base at the bottom. Again, we've got these two shoulders on the left and right and the head in the middle, and then it breaks back up through the waistline there and it creates a buy, and the price continues on upwards. So that is the simple pattern of bearish and Buddha. Now that is the perfect example. There are variants of it, it doesn't have to be that perfect, and sometimes they're quite hard to spot, but again, a useful reversal pattern to look out for. I would use it in conjunction with other indicators on top of that to confirm the reversal in the price. And finally, we've got what I call the shoulder waist chain setup. Very useful for risk management or trade sizing, getting bigger, adding to your trades, or target setting. Now in Japan they use something called a 9 shoulder or waist sequence, and when it got to that 9th shoulder, they started to believe that that was the trend starting to possibly wear out, and would sort of heighten the awareness to look for signals for a change in trend direction. Quite hard to spot the 9 shoulder pattern. Let's take a look at an example so you can see what we're talking about. So here we have an example. It's daily USD JPY currency pair, and it's set to 0.5. I found a 7 wave down. Couldn't find a 9 for the purposes of this example. That's just to give you an idea of how the patterns play out. You might have a different rule. You don't have to use the 9. You might have analysed that 7 is the magic number there before it turns around. So do your research, find out what works by the particular market that you're analysing. But again, another useful bit of analysis that you can apply on top of the KAGI lines. Now here we have the Nikkei 225. It's a Japanese stock market index, and I've added an indicator below the chart, and I've drawn on trend lines and added a moving average and put on some of the terminology that we'll look at that is unique to the KAGI chart. But you can see, because of the simplification of the data, trades like breakouts are more obvious. We can find support and resistance areas more easily, and you'll get to learn that the red and the black lines mean something, and in this example here, the blacks mean it's a buy opportunity, the reds a sell, and we learn how to interpret those. So again, the trading psychology and consistency and discipline is made a lot easier. We marry that up to Western techniques that we can now apply on top of these type of charts due to advancements in technology. We can then create powerful, consistent trading strategies that you will be able to easily apply to your trading. Another example for you, just to show you how you can enhance the strength of the KAGI charts further by adding on further indicators. Now on this one, it's the USD JPY again, and I've added on a Bollinger breakout strategy idea. You can see there the two white bands as the price comes on out through. I'm looking for that breakout. Also timed that in with the DMI here, modified fast DMI set to 7. You can see when they cross how the markets change. But also on top of that, I'm using the price pattern information that we've looked at in this video, things like trend lines. We've got the ladders and all those types of patterns that we've seen. Build them in as extra confirmation. Start with the price action and work your way backwards, or just limit it as much as you like. You don't have to have these indicators on, take them off. Just have maybe the breakout as a confirmation. Totally up to you. Have a play, see what you come up with. But like I said, the price patterns I find are very effective on the KAGI chart. Makes KAGI charts easier to use. But I do like to add on the Western indicator to the strategy, just to add the extra bit of confirmation. It's just my way of trading, how I think. But like I say, go and play and see what you come up with. So there you go. I hope that's given you some ideas and some thought as how you can build out your trading, taking a different chart type that gives you a different angle, a different possible edge in, and then utilizing what that offers you. And in this instance, as I mentioned, the KAGI charts work very nicely with price action, and I've given you some examples of how to enhance that using Western type indicators. So there you go. Have a go away and play with the setups. Let me know in the comments below what you think and whether you have any success with that style of chart and the patterns. And if you're new to KAGI, like I said right at the start, you want to learn more, get into the detail of it, understand it before diving in to this any further, then that video, totally free course, is coming up right now.